Good afternoon, and thank you for joining us outside the New York Stock Exchange. I'm Olivia Bono-Voznenko, and I am here with Stephen Guilfoyle to talk about the hottest topics of 2017. Hello, Sarge. Happy New Year.
Happy New Year, Voz. It's a pleasure to see you. It's been a while.
Oh, thank you. Well, in T-minus just a couple weeks, the Donald is coming in and taking over office. Now, President Obama has set up a couple hurdles in the meantime. One of them is protecting land in Utah against oil exploration. So with that said, what hurdles are higher and which ones should investors be eyeing?
The hurdles will really be the level of execution and implementation that the president-elect's policies are carried out. We know deregulation is in the offing. We know repatriated money is in the offing. We know lower taxes for corporations and probably for individuals as well are in the offing. But how far will they go? I believe the most important thing will be the corporate tax rate. Right now it's 35%. The proposal is 15%. The reality will probably be somewhere like 25%, which is a really huge deal. For every 1% that you can cut the corporate tax rate, you can probably increase overall S&P earnings by $1.25 to $1.40. So as far as earnings go, and earnings are the ultimate driver of stock prices, that is the hugest deal.
Okay, Sarge, well, I just want to draw our focus back to oil real quick because it's been on a rip since the OPEC agreement. Now, could that motivate countries like Russia to do some geopolitical advances, and how will the market react to that?
More than Russia, which does rely heavily on oil, I believe you're going to see production ramped up here in the U.S. in the Permian Basin. As long as the price of WTI stays in the 50s, we've seen stiff resistance at $55 a barrel. We're seeing support around $52 a barrel. If you can get through 55 and hold it, you can go to 58. But it's not looking like that's possible right now. Right now, we're in really a cozy spot. Everyone's watching OPEC to see if they'll cheat or not. I'll tell you right now, they'll probably cheat, okay?
Okay.
But I think more so is the ramped up production coming out of the U.S. That Permian Basin, and some of those companies that can really not only ramp up production but do so profitably, that might be where you find the benefit in the energy sector. I mean, just look at yesterday. The energy sector, although oil really got hurt yesterday, I was thinking it was down a couple percent by day's end. The energy sector was one of the strongest sectors yesterday. It was in the top four, over 1% higher. So that's really where you got to watch the balls roll around.
Okay, well, under the events, under the 2017 expectations, one of them is interest rate hikes, or I guess a few of them. Now, this is Janet Yellen's last year as chair, so what will the motive be behind the rate hikes? Will it be political or just fairly under data?
It's been a little political in the past. I don't think they're going to go anywhere near the 3 or 4 rate hikes a lot of people are talking about, unless the economy calls for it. I don't think that these policies we just discussed will get there this year, or at least in the first half of this year. So for them to force the issue and raise rates anytime soon would probably be painful. Painful for the economy, painful for the American people. So I don't think they should go there. Fortunately, the makeup of the FOMC is now more dovish than it was last year. So now you got guys like Charles Evans and Neil Kashkari. They have votes this year. They're kind of dovish guys. Gone are Loretta Mester and Esther George. Both of them were hawkish gals. Mm-hmm. So we probably have a little bit of an easier time as far as doves versus hawks goes. Ultimately, we want to see growth, we want to see inflation, we want to see wage growth, and we want to see higher interest rates. Because that would be better for everyone in the end, but we don't want it too soon.
All right, I tried to crack him, no dirty politics, but Sarge, finishing up real quick, this Friday, jobs, your take.
All right, we're probably going to get a number around 170, something like that. But non-farm payrolls, usually the headline number, are not the headline number this time. This time it's going to be wage growth. All right, wage growth got kicked in the teeth back in November, down 0.1% month over month. We need to see a positive print of 0.3% month over month, or else it's a failure. So that's what we want to see.
All right, well, Stephen Guilfoyle, Happy New Year. Thanks for joining me.
Happy New Year.